It is Friday, November 16th, 2018. It is 8 p.m. Pacific Standard Time, and so you know what time it is. It's time for a little bit of coin metal. And so, today was a very get your ass kicked at Jiu-Jitsu Friday. I don't know what it was. I guess the universe decided I was crowing a little too much last time around, and it needed to pair me with somebody that could roundly defeat me at any moment. And so yeah, it was a very, very interesting class. We worked some omoplata today, and that's a movement that I'm not incredibly terribly familiar with. I think I was telling Coach during class, I think we've covered it like maybe 2, maybe 3 times in the whole time that I've been training there. So you know, it's one of those things I wasn't really anticipating getting into, but I was very, very happy to, of course, because I like to practice. I like to get practice on new things, especially. But so yeah, we did a little bit of omoplata today, and a few adjustments on how to set it up and whatever from the full guard position or from a guard position, like a loose butterfly guard kind of position. But anyway, yeah, everything was fine until the last couple of rolling sessions, and then I got my attitude readjusted, or my ego tuned down a little bit. There's this gentleman, younger guy. I'm not going to name him because I don't want you to have any clue until it's too late. But really, I kind of accused him of being a ringer when we were in the dressing room after class. I'm like, that isn't the first white belt you've ever worn, is it? He's like, no. But I didn't know it, but apparently he does come in quite a bit, and he has been for the last, I guess, 6 months. So it was just something that, our paths never crossed. And so I thought he was new. But no, he is not. But I still maintain the position that I think that he's had either some jiu-jitsu training previously, maybe not gi jiu-jitsu, maybe 10th Planet, or at least wrestling, one of the two. I don't know, but the guy was on it, and he executed very, very well. His grips were good, nice and tight, and it's one of those situations where it's really funny because, like last time around, I was saying that I outweighed my sparring partners by about 60 pounds. And that was only true for one of them today, and it was him. I outweighed him by about 50, 60 pounds. And still, I could not get around his guard worth of shit. I did manage to break free from a few armbar attempts, but he was really good at chaining his transitions. He was going from one to another really, really well. And so, I couldn't help but be impressed by the way he was moving. Just the same, it was very aggravating having somebody who's just a single stripe white belt who I can't get around their legs. But to my comfort, and this was my second saving grace here, was that after he sparred me, he sparred the other person in our 3-person group, and he was actually a multiple stripe blue belt. And from what I could see, he had to dig deep into the fucking treasure trove to find the way to spin this guy around. I mean, he was doing inversions, he was doing all kinds of shit to get this kid to a choke position, and finally he did, like maybe 15 seconds before the bell rang off. So I don't feel too bad about it that a guy who I normally have a lot of trouble with, and I think the only reason why I stayed on the mat as long as I did with him was because I was trying to tie him up a bit. I got a lockdown on one of his legs after he got to half guard, and it was really fun rolling with him. I wish I could spend like a few hours rolling with him, because even though we would have had to like reset every 15 seconds because he's just getting to it that fast, it would have given me a little more experience with his style, because he was so patient, he was on me, and like as soon, and I mean like as soon as my ankles disengaged from behind his back, he was moving. And I'm like, oh man, that was impressive that he just picked on it so fast. And so I would definitely like to spend a few more hours rolling with him just to try and get some of that to rub off, maybe. Anyway, enough of that. We did get a couple of albums added to the repertoire. Unfortunately, I'm going to have to wait until next week for the majority of them to get here, but they will get here nonetheless. And so I think I'm just going to open it up with a little body count. And so here it is. No Lives Matter. First Dance. Here on Coin Metal. And that was Power Man 5000 with When Worlds Collide. Yeah. And so apparently I've been putting this in the wrong room this whole time. Yeah, I was in the Verge admin channel instead of the normal channel, so had to fix that. Anywho, as far as what we're going to cover today, well, I've got a few things on my mind, and I think I'm just going to start off with this this SEC statement. And I think it's kind of, how should I say this, appropriate that it should be happening now. See, I started wondering about the whole forking event with regard to Bitcoin Cash, and I saw some things on Bitcoin that kind of concerned me a little bit, mostly because I don't like SegWit, and the SegWit adoption has been going up, and all of this while now I would like to step back from that and just say that in reality what I think is going on is that there's not really more SegWit transactions going on. It's that what's happening is there are less regular Bitcoin miners on the network. So the blocks that are being processed by miners that do support SegWit. And so I think that more SegWit transactions appear to be there because, well, there's less regular Bitcoin transactions. So it's more it's more a result of attrition as opposed to actual adoption. And I've said that quite a few times now, that I think that SegWit coin is its own coin and that it's not necessarily Bitcoin. It looks like it's dithering around 40%, but there was a massive spike where it had gone up quite significantly and relatively recently too. That was the Liquid sidechain launch, apparently. And so, the whole bunch of SegWit outputs on that one, I'm sure, and inputs as well. But anyway, the point being that I've never looked at SegWit as a way out of the whole block rising thing, or what is it? I was just looking at this whole thing, and it looks like I'm reading this chart here, and it shows from the SegWit activation, and then also the Liquid sidechain launch, and it's funny because after the Liquid sidechain launch, the number of SegWit transactions actually dipped a little bit. But I'm having trouble reading this thing just because it's got different lines denoting different things, and on this one it's showing that, let's see here, about 100,000 SegWit transactions. It's on a mild raise, But anyway, the point I was getting at there is that while there was this whole shitstorm going on Bitcoin Cash, and this wasn't just the result of Roger switching it over, but apparently some miners that were mining just the just regular Bitcoin transactions shifted over to Bitcoin Cash for the forking. And so yeah, whether or not that's actual adoption or represents actual adoption, I don't think so. I just don't think so. Anyway, I do want to get into something additional that I found, and this is on NakamotoStudies.org, and apparently somebody has been posting on Twitter as quote-unquote Satoshi Nakamoto, and apparently Satoshi seems to think there's something wrong with SegWit, and I don't know, I happen to agree with him. But anyway, yeah, so lately on Twitter, Satoshi Nakamoto has been tweeting, and oh, wait a minute, it says the message will be clear in December 2019. I don't want to be public, but there is an issue with SegWit. If it is not fixed, there will be nothing, and I would have failed. There is only one way that Bitcoin survives, and it is important to me that it works. Important enough that I may be known openly. And so that's kind of interesting, and interesting timing that that this should be going on. You know, that we should see some apparently. I'm reading something on blockchain.org, and apparently it's a link to a transaction, and I don't know enough about reading it to tell you whether or not it was the Satoshi's keys that were moving, but yeah, apparently there's been a little bit of movement, and I don't know enough about it. This wallet, if it is Satoshi's, I would need to study up a bit more. But anyway, we are going to get into something else to kind of tune us back into where we originally started. But first, I'm going to cover something about where we are today. And see, I don't think that there are any state or national entities that have any say over cryptocurrencies. Meaning that a 14-year-old has as much authority over the policies of a currency now that the head of the Federal Reserve did in 2008 over the U.S. dollar. And so it's really funny to me that any national organization or any government entity should be poking at it and saying, this is what you can do with it. No. Some 14-year-old kid in Thailand tells me what I can do with it because he sets the consensus rules of the coin that I'm transacting in. You know, some guy in Florida, he determines the monetary policy of the coin that I transact in. Not the Federal Reserve, not the SEC, not the CFTC, not the FDIC, none of these people. Anyway, got this thing on, it's a public statement by the U.S. Securities and Exchange Commission, Statement on Digital Asset Securities, Issuance and Trading, Division of Corporation Finance, Division of Investment Management, and Division of Trading and Markets. This is authored November 16th, 2018. In recent years, we have seen significant advances in technology, including blockchain and other distributed ledger technologies that impact our securities markets. This statement highlights several recent Commission enforcement actions invoking the intersection of long-standing applications of our federal securities laws and new technologies. The Commission's divisions of corporation finance, investment management, and trading in markets, the divisions encourage technological innovations that benefit investors and our capital markets. And we have been consulting with market participants regarding issues presented by new technologies. We wish to emphasize, however, that market participants must still adhere to our well-established and well-functioning federal securities law framework when dealing with technological innovations, regardless of whether the securities are issued in a certificated form or using new technologies such as blockchain. In other words, we regulate shit that hasn't even been invented yet just because it kind of looks like a security to us. Fuck you. Continuing on. The Commission's recent enforcement actions involving AirFox, Paragon, Crypto Asset Management, Token Lot, and EtherDelta's founder, discussed further below, illustrate the importance of complying with these requirements. Broadly speaking, the issues raised in these actions fall into three categories. Number one, initial offers and sales of digital asset securities, including those issued in initial coin offerings, ICOs. 2. Investment vehicles investing in digital asset securities and those who advise others about investing in these securities. Number 3. Secondary market of trading digital asset securities. Below, we provide the division's views on these issues. Offers and sales of digital asset securities. The Commission has brought a number of actions involving offerings of digital asset securities. To date, these actions have principally focused on two important questions. First, when is a digital asset a, quote, security for purposes of federal securities laws? Second, if a digital asset is a security, what Commission registration requirements apply? None! Fuck you people! The importance of these and related issues is illustrated by several recent Commission enforcement actions involving digital asset securities. In particular, the remedial measures in two of these matters demonstrate a way to address ongoing violations by issuers that have conducted illegal unregistered offerings of digital asset securities. Today, the Commission issued settled orders against AirFox and Paragon in connection with their unregistered offerings of tokens. Pursuant to these orders, AirFox and Paragon will pay penalties and also have undertaken to register the tokens as securities under Section 12G of the Securities and Exchange Act of 1934 and file periodic reports with the Commission. They have also agreed to compensate investors who purchase tokens in the illegal offerings if an investor elects to make a claim. The registration undertakings are designed to ensure that investors receive the type of information they would have received had these issuers complied with the registration provisions of the Securities Act of 1933 prior to the offer and sale of their tokens in their respective ICOs. With the benefit of ongoing disclosure provided by registration under the Exchange Act, investors who purchase the tokens from the issuers in the ICOs should be able to make more informed decisions as to whether to seek reimbursement or to continue to hold their tokens. These two matters demonstrate that there is a path to compliance with federal securities laws going forward, even where issuers have conducted an illegal unregistered offering of digital asset securities. Oh, great. There's a route to make us compliant. Oh, man, I feel so relieved. Continuing on. Investment vehicles investing in digital asset securities. The Investment Company Act of 1940, Investment Company Act, establishes a registration and regulatory framework for pooled vehicles that invest in securities. This framework applies to a pooled investment vehicle and its service providers even when the securities in which it invests are digital asset securities. On September 11, 2018, the Commission issued a crypto asset management order finding that the manager of a hedge fund formed for the purposes of investing in digital assets had improperly filed to register the fund as an investment company. The order found that the manager engaged in an unlawful, unregistered, non-exempt public offering of the fund. By investing more than 40% of the fund's assets in digital asset securities and engaging in public offering of interests in the fund, the manager caused the fund to operate unlawfully as an unregistered investment company. The order also found that the fund's manager was an investment advisor and that the manager had violated the anti-fraud provisions of the Investment Advisors Act of 1940. By making misleading statements to investors about in the fund. My apologies. Investment vehicles that hold digital asset securities and those who advise others about investing in digital asset securities, including managers of investment vehicles, must be mindful of registration, regulatory, and fiduciary obligations under the Investment Company Act and the Advisors Act. Trading of digital asset securities. Commission actions and staff statements involving secondary market trading of digital asset securities have generally focused on what activities require registration as a national securities exchange or registration as a broker or dealer, as those terms are defined under the federal securities laws. Exchange registration. Advancements in blockchain and distributed ledger technology have introduced innovative methods for facilitating electronic trading in digital asset securities. Actually, I just want to pause here and say these are the monkeys that are calling things digital asset securities. Nobody in fucking cryptocurrencies calls anything that they are transacting in or trading digital asset securities. So, in other words, these fuckers are just talking to themselves, and you cannot take them seriously. Continuing on. Platforms colloquially, I have the hardest time saying that word, colloquially referred to as, quote, decentralized trading platforms, for example, combine traditional technologies such as web-based systems that accept and display orders and servers to store orders with new technologies such as smart contracts run on a blockchain that contain coded protocols to execute the terms of the contract. These technologies provide the means for investors and market participants to find counterparties, discover prices, and trade a variety of digital asset securities. A platform that offers trading in digital asset securities and operates as a, quote, exchange, as defined by the federal securities laws, must register with the Commission as a national securities exchange or be exempt from registration. I say you're all exempt. There you go. The Commission's recent enforcement action against the founder of EtherDelta, a platform facilitating trading digital asset securities, underscores the Division of Trading and Markets' ongoing concerns about the failure of platforms to facilitate trading in digital asset securities to register with the Commission, absent an exemption from registration. According to the Commission's order, EtherDelta, which was not registered with the Commission in any capacity, because they're not actually bound to, provided a marketplace for bringing together buyers and sellers for digital asset securities through the combined use of an order book, a website that displayed orders, and a smart contract run on the Ethereum blockchain. Ether Delta's smart contract was coded to, among other things, validate order messages, confirm the terms and conditions of the orders, execute paired orders, and direct the distributed ledger to be updated to reflect the trade. The Commission found that Ether Delta's activities clearly fell within the definition of an exchange, and that Ether Delta's founder caused the platform failure either to register as a national securities exchange or operate pursuant to an exemption from registration as an exchange. Yeah, there's a reason why they don't bother with you. Because as soon as they present their materials, you go into the back room, you rejigger around the information into where, oh yeah, this stupid fucking law that hasn't been applied since 1805 applies to your shit, and so now you have to register with us and give us some fucking money. Fuck you people! It's like this idea of quote-unquote security tokens or utility tokens. That's just a fucking trap for you people. You know, you'll write up your white paper and you'll include those words like a fucking idiot. And then, unbeknownst to you, the SEC will entitle some action. Okay, yeah, we're now going to regulate utility tokens and this is how you have to use them. And you better fucking comply or they're going to do some sort of enforcement action against you. This is how the game is being played, kids. They are not playing fair. They have the rule book and a pencil that they can write in new rules with. This is why you do not seek to become one of them. This is why you do not seek to work from the inside. You just do your shit. Do your shit. Be honest and make good. You do those things, nobody will bother to report you. Continuing on. Any entity that provides a marketplace for bringing together buyers and sellers of securities, regardless of the applied technology, must determine whether its activities meet the definition of an exchange under the federal securities laws. And just to let you know, Ether Delta was probably 100% compliant and probably 100% exempt from any federal registration. The only reason that there was an enforcement action against them is because the SEC had a wild hair up their ass and said, these guys didn't bother to check if they are exempt. We better go after them and bust them. Fuck you. Continuing on. Let's see where we are. Exchange of securities, regardless of the applied technologies, must determine whether its activities meet the definition of an exchange under federal securities laws. The Exchange Act Rule 3B-16 provides a functional test to assess whether an entity meets the definition of an exchange under Section 3A.1 of the Exchange Act. An entity that meets the definition of an exchange must register with the Commission as a national securities exchange or be exempt from registration, such as by operating as an alternative trading system in compliance with regulation ATS. And one thing, what number of market participants have ever gone to the SEC and actually were defined as an alternative trading system by them? I would wager it's very, very minute, very, very tiny, as in they probably only give the Federal Reserve that kind of exemption. Continuing on. Notwithstanding how any entity may characterize itself or the particular activities or technology used to bring together buyers and sellers, a functional approach, taking into account the relevant facts and circumstances, will be applied when assessing whether a system constitutes an exchange. The activity that actually occurs between buyers and sellers, and not the kind of technology or the technology used by the entity operating or promoting the system, determines whether the system operates as a marketplace and meets the criteria of an exchange under the Rule 3B-16A. For instance, the term order, for purposes of Rule 3B-16, is intended to be broadly construed. Yeah, so we can just make up shit on the spot. and the actual activities among buyers and sellers on the system, not the labels assigned to the indications of trading asset interests, will be considered for purposes of the exchange analysis. And just I want to step off here and just say, when we read the brief description they gave of Ether Delta and how Ether Delta works, there are no third-party intermediaries interacting in that shit. It's all happening on the blockchain. And what you have to understand about the SEC and their regulation of market participants is they are evaluating the market participants to determine whether or not they're fiscally or otherwise capable of being trusted with your funds. Now, if you don't actually handle your customers' funds, there is no need to actually trust you with them. You see where I'm going with this? This is where the SEC is completely inapplicable under the Securities and Exchange Act. Because we're not talking about trust. I put up a price, somebody decides that they want to exchange at that price, and the marketplace is just a viewing place for us to share the volumes that we have and to arrange the trade ourselves according to the conditions that we see fit. Under those circumstances, as long as all parties are actually being made whole by the system in question, then there is no place for the SEC to regulate jack shit. Because there's not a third-party intermediary making the transaction happen, other than, of course, the author of the code and maybe the site manager. But if they're not actually interacting with the trades themselves, and they aren't holding your funds, there's no reason to trust them. They are not custodians of your funds. And that's another place where the SEC and the CFTC do not have any grip here. Continuing on. The exchange analysis includes an assessment of the totality of activities and technology used to bring together orders of multiple buyers and sellers for securities using, quote, established non-discretionary methods under which such orders interact. A system, quote, brings together orders of buyers and sellers if, for example, it displays or otherwise represents trading interest entered on a system to users, or if the system receives users' orders centrally for future processing and execution. Yeah, I bet you anything they made that bullshit up about 2 weeks ago. They said, how do we bust Ether Delta? Okay, well, if it just presents a price and an interest display... Okay, now we're covered. Now we can go bust Ether Delta for doing nothing wrong. Continuing on. A system uses established non-discretionary methods if it provides a trading facility or sets rules. For example, an entity that provides an algorithm run on a computer program or on a smart contract using blockchain technology as a means to bring together or execute orders could be providing a trading facility. As another example, an entity that sets execution priorities, standardizes material terms for digital asset securities traded on the system, or requires orders to conform with predetermined protocols of a smart contract could be setting rules. Fuck you. Additionally, if one entity arranges for other entities, either directly or indirectly, to provide the various functions of a trading system that together meet the definition of an exchange, the entity arranging the collective efforts could be considered to have established an exchange. Alright, let's get real for a moment, folks. The text here just made every single marketplace where something is being traded, and regardless of what it is, into an entity that has to comply with the SEC's regulations. Think about it. If I offer, massages for Dogecoin, If I display a price in Doge for a massage and somebody agrees to it, we have just violated SEC's regulations. I mean, literally, like a lemonade stand violates the securities laws according to how broadly they've construed these terms. Continuing on. Broker-dealer registration. An entity that facilitates the issuance of a digital asset security in ICOs and secondary trading in digital asset securities may also be acting as a, quote, broker. Oh, wait a minute, I skipped over some shit. Oh, sorry. As another example, an entity that sets execution priorities, standardizes material terms for digital asset securities traded on a system, or requires orders to conform with predetermined protocols of a smart contract, could be setting rules. Additionally, if one entity arranges for other entities, either directly or indirectly, to provide various functions of a trading system that together meet the definition of an exchange, the entity arranging the collective efforts could be considered to have established an exchange. So yeah, lemonade stand. It's now an exchange, has to register with the SEC or check to see whether or not they're actually exempt. These fucking people are crazy. And more importantly, I think this is probably the most important part. One of the reasons why they also define things so broadly is so that they can select between the people they like and the people they don't like. The people they don't like, they're going to throw the book at. The people they like, they'll take it easy on. And Goldman Sachs will be able to continue acting in violation and in non-compliance, and no one will really give a shit because the SEC isn't holding them to account, so, why should we, right? Continuing on, broker-dealer registration. An entity that acts that facilitates the issuance of digital asset securities in ICOs and security trading in digital asset securities may also be acting as a broker or dealer that is required to register with the Commission and become a member of the self-regulatory organization, typically FINRA. Among other things, SEC-registered broker-dealers are subject to legal and regulatory requirements that govern their conduct in the marketplace and that provide important safeguards for investors. Yeah, none of that shit applies to cryptocurrencies. Why? Because some 14-year-old in fucking Uzbekistan sets the monetary policy for the currency I'm trading in. So, sorry SEC, you can go fuck yourself. Continuing on. Section 15A of the Exchange Act provides that absent an exemption or exception or exemption, meaning if the head of the SEC gives you an exception or an exemption, you're all cool. It is unlawful for any broker or dealer to induce or attempt to induce the purchase or sale of any security unless such broker or dealer is registered in accordance to Section 15B of the Exchange Act. Section 3A.4 of the Exchange Act generally defines a broker to mean any person engaged in the business of effecting transactions in securities for the account of others. So your little sister better not be cheerleading for you, or she might have to register as a broker or dealer. There you go. Section 3A.4 of the Exchange Act generally defines a broker to mean any person engaged in the business of effecting transactions. Okay. Section 3A.5 of the Exchange Act generally defines a dealer to mean any person engaged in the business of buying and selling securities for such person's own account through a broker or otherwise. As with the exchange determination, a functional approach, taking into account the relevant facts and circumstances, is applied to assess whether an entity meets the definition of a broker or dealer, regardless of how an entity may characterize either itself or the particular activities or technologies used to provide services. The Commission's recent Token lot order illustrates the application of the broker-dealer registration requirements and entities trading or facilitating transactions in digital asset securities, even if they do not meet the definition of an exchange. According to the order, token lot was a self-described, quote, ICO superstore where investors could purchase digital assets, including digital asset securities, during or after an ICO, including in private sales and pre-sales. The party's brokerage activities included marketing and facilitating the sale of digital assets, accepting investors' orders and funds for payment, and enabling the disbursement of proceeds raised in the ICOs, subject to a guaranteed minimum commission. Token lot also acted as a dealer by regularly purchasing and then reselling digital tokens for accounts in token lot's name and were controlled by its operators. Conclusion: the divisions encourage and support innovation in the application of beneficial technologies in our securities markets. However, the divisions recommend that those employing new technologies consult with legal counsel concerning the application of federal securities laws and contact the Commission staff as necessary for assistance. For further information, and to contact the Commission staff for assistance, please visit the Commission's new FinHub page. I don't think so. You know, the thing is that I think these people are really overstepping their bounds, and I really wish that a lot more people in crypto would be taking them to court. They do not favor innovation. They just favor innovation being done by Circle or innovation being done by Goldman Sachs, not by you. That's not a fair application of the law. And I mean, I can't tell you how many articles I've read about all of the fucking illegal shit that Goldman Sachs gets away with. And they are supposedly SEC compliant. You know, and we don't find out about it until long after all of the people, all of the principals that were involved, all of the investors that those principals were acting on behalf of are already withdrawn. They've already taken their cut. And they've left us with the scraps, and then the SEC comes along and says, oh, by the way, we've been investigating these guys for 18 months, and they're out of compliance. And so there you are telling your fucking broker, hey man, sell it. And they're like, no, not right now, just a little bit longer. Sell it. No, dude, just a little bit longer. It's going to go back up. You know, meanwhile, he's already prioritized his list of customers, and you are not within the top 10, so he's not executing your orders in time. No, he's dealing with, you know, Bank of America's orders and the Federal Reserve's orders and everybody else above you first. So by the time you're out, you've lost another 20%, 30%, 40%. Yeah. Que sera, sera. It was all compliant. It was all legal. It was fully regulated. You just got to suck it up. And as far as these people, you know, the SEC saying that they're all about innovation, we've been developing this shit to get around that morass, and here they are stepping on us saying, no, we want you back under here. We want you getting your ass raped by Goldman Sachs on their fucking exchange. We want you to lose money to them first. Because we make money then. We get some sort of kickback out of that, I'm sure. And they wonder why we don't bother to register with them. Because they're reviewing our prospectus materials and saying, well, let's see, if we tweak, paragraph 3 of Securities Exchange Act, section 15B4, if we tweak that instead of is, and it will put was and broker-dealer in there, and now all these fuckers that are participating in this, they're doing so illegally, and we're going to have to slap an enforcement action on them. And of course, they only do that with people like Ether Delta. They don't do it with Goldman Sachs. Goldman Sachs right now, as far as I'm concerned, they're counterfeiting U.S. dollars with every USDC that's traded, that's brought onto an exchange. But we're not even going to bother with that one until it loses its peg for a significant duration of time, and maybe some institutional investor loses a shit ton of money, and then maybe the SEC will say something about it. But Goldman Sachs will get off without any prison sentences, without any real enforcement actions. Maybe a fee or some sort of lack of compliance misdemeanor bullshit, charge a few $1,000, maybe even a few $1 million. And they'll get away with having sucked billions of dollars out of the fucking cryptocurrency market via the inflation of their own units. And this is why I stay away from any kind of fucking stable coin. It's bullshit. It's nothing short of counterfeiting. Anyway, let's go ahead and throw back down into some music. I wanted to give you guys a understanding of at least a little bit of the thinking that they're operating on. That basically if it even comes close to a security, if it even comes close to something that they can regulate, you better have a fucking cadre of lawyers and a shit ton of money that you can fight those people with. Because otherwise, they're going to try and do some sort of fucking enforcement action on you. Anyway, like I said, let's go ahead and throw back down into some music. And what to put in? We didn't play any Meshuggah last time around, so here it is, Electric Red, for all you Bitcoin Cash traders out there. And that was Slayer with Seasons in the Abyss. I really like that album, and pretty much everything on it is top notch. Anywho, I wanted to get a little bit further with the information that I gleaned off of Satoshi Nakamoto's tweets. And before that, though, I did have another article here that I wanted to get into. I'm trying to see where it is here. And this one's on ft.com. And this is just to give you a retrospective, possibly. I haven't actually read the article itself, but judging from the title of it, I believe it probably will give us some information that will be pertinent to the overall subject matter this evening. And this is on ft.com. It's from R.C. Whalen, New York, U.S. This is published November 4th, 2018. You state in your editorial November 1st that former Federal Reserve Chair, this is Yellen and Bernanke both deserve Volcker's rebuke. This is the title of this. You state in your editorial November 1st that former Federal Reserve Chair Janet Yellen is right to be worried about excessive corporate debt. But wait a minute. Did not Ms. Yellen and her colleagues on the Federal Open Market Committee, FOMC, and other global central banks, to be fair, cause the accumulation of corporate debt by manipulating interest rates and credit spreads? Is it really possible that Ms. Yellen fails to understand that the Fed's deliberate manipulation of the credit market since 2008 enabled this worrisome accumulation of corporate junk debt? In his book, Keeping at It, The Quest for Sound Money and Good Government, Paul Volcker, the former Fed chairman, delivers a sound rebuke to former Chairman Ben Bernanke, 2006 through 14, and Ms. Yellen for spending too much time focusing on deflation and not worrying about the collateral damage of excessive ease. He writes, quote, "The real danger comes from encouraging or inadvertently tolerating rising inflation and its close cousin of extreme speculation and risk-taking, in effect standing by while bubbles and excesses threaten financial markets. Ironically, the easy money, striving for a little inflation as a means of forestalling deflation, could, in the end, be what brings it about. Mr. Bernanke and Ms. Yellen are singularly responsible for the accumulation of sovereign and corporate debt over the past decade. For Ms. Yellen now to suggest increased regulation to offset the negative impacts of her policies seems absurd. Perhaps you should take a fresh look at this situation so as not to seem completely incredible yourselves. And this is by R.C. Whalen, Chairman, Whalen Global Advisors, New York, U.S. And difficult to argue with the last true central bank that the U.S. had. Yep. Anyway, I was just reviewing a comment on there, but so that kind of gets to the meat of it, and it seems to me that we should probably refer back to the editorial that it actually referred to, but unfortunately we don't get that. Damn it, Jim. Print only. What? These bastards. No, I don't want any of this shit. Anyway, I was hoping to read this editorial, but it's a bum link. Yeah. But this is the intention I had by putting this in here is that this is the mentations of people that are running the monetary policy for the U.S. dollar and the banks that handle it. And so their influence is a bit quote unquote centralized, if that should be the term that I would apply to it, at least. And the results of it, the results of the market being subjected to these centralized decisions, are exactly why cryptocurrencies exist. Satoshi Nakamoto didn't just, snap his fingers one day and say, you know what, I'd really like to make my own global digital currency standard and distribute it and let everybody else try and play with it. That didn't happen. As evidenced by the message in the Genesis block. He was very intentional about what he was doing with Bitcoin. And he was very intentional by the way that he set it up. When you hear the types of activities that we've been talking about with regard to what the SEC thinks they can and cannot regulate, and what activities may in fact be entirely exempt and beyond question absolutely so, it's something to keep in mind when reviewing these materials by Satoshi Nakamoto, is that he was outlining a system that, according to his own understanding of things, would completely be exempt from the types of activities where regulators and centralized organizations could basically take this out of the hands and out of the control of the participants on the network. In this hash war, if anything, it should show you the danger of relying on other miners to mine on your behalf or to represent your interests. Is that they are not actually obligated to. If it's their hardware, it's their hardware. Ultimately, they have the final say on exactly where it's pointed, what it's mining, what BIPs they enforce, all of that shit. That's up to them. Now, why would you expect that they would act against their own interests, possibly, by executing your will on their hardware? I mean, if I knew I could make more money if I made a decision on my hardware, which variant of Bitcoin to mine or whatever, that at least is my expression of my interest. I'm not relying on somebody else to execute it. It's my hardware, it's my software, it's my bandwidth, it's my electricity. They can go blow me. Anyway, where I was going with this, and why I'm introducing things in kind of the sequence that I am, you'll understand it soon enough. And this is on the webpage nakamotostudies.org. Bitcoin V 0.1 released. This is supposedly put up January 9th, 2009 by Bitcoin Cash. It's really funny. The following email is Satoshi's official announcement of the first version of the Bitcoin source code. It is one of his most important emails. Announcing the first release of Bitcoin, a new electronic cash system that uses a peer-to-peer network to prevent double spending. It's completely decentralized with no server or central authority. See bitcoin.org for screenshots. Download link, blah blah blah, sourceforge.net. Windows only for now. Open source C++ code is included. Unpack the files into a directory, run bitcoin.exe. It automatically connects to other nodes. If you can keep a node running that accepts incoming connections, you'll really be helping the network a lot. Port 8333 on your firewall needs to be open to receive incoming connections. The software is still in alpha and experimental. There's no guarantee the system's state won't have to be restarted at some point if it becomes necessary. Although I've done everything I can to build in extensibility and versioning. You can get coins by getting someone to send you some, or turn on options, generate coins to run a node, and generate blocks. I made the proof of work difficulty ridiculously easy to start with, so for a little while in the beginning, a typical PC will be able to generate coins in just a few hours. It'll get a lot harder when the competition makes the automatic adjustment drive up the difficulty. Generated coins must wait 120 blocks to mature before they can be fully spent. Be spent. There are two ways to send money. If the participant is online, you can enter their IP address and it will connect. Get a new public key and send the transaction with comments. If the recipient is not online, it is possible to send to their Bitcoin address, which is a hash of their public key that they give to you. They'll receive the transaction the next time they connect and get the block it's in. This method has the disadvantage that no common information is sent, and a bit of privacy may be lost if the address is used multiple times. But it is a useful alternative if both users can't be online at the same time, or if the recipient can't receive incoming connections. Total circulation will be 21 million coins. It will be distributed to network nodes when they make blocks, with the amount cut in half every 4 years. The first 4 years, 10,500,000 coins. The next 4 years, 5,250,000 coins. The next 4 years, 2,625,000 coins. The next 4 years, 1,312,500 coins. 312,500 coins. When that runs out, the system can support transaction fees if needed. It's based on open market competition, and there will probably always be nodes willing to process transactions for free. Satoshi Nakamoto, the cryptography mailing list, unsubscribe by sending blah 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 blah. Notable sections. Quote, I made the proof of work difficulty ridiculously easy to start with, so for a little while in the beginning, a typical PC will be able to generate coins in just a few hours. It'll get a lot harder when competition makes the automatic adjustment drive up the difficulty. Quote, when that runs out, the system can support transaction fees if needed. It's based on open market competition, and there will probably always be nodes willing to process transactions for free. Quote, the total circulation will be 21 million coins. It'll be distributed to network nodes when they make blocks, with the amount cut in half every 4 years. So there you have it. That's Satoshi's description in the email of how it was supposed to work. Let's check some other stuff here. Some email index. Ooh, wow, a lot of material here. I'm gonna have to read through this at a later date. But anyway, I wanted to get back to where we kind of started off with Bitcoin. You know, what was the intention? Why did they bother? You know, how did he or how did she or they intend it to operate? Well, it's not very difficult to find the materials that you're looking for if you are trying to establish those things. And one thing has remained true throughout the entire time that I've been involved with cryptocurrencies is that it is incumbent upon you to do your own homework. You know, if you're truly interested in this stuff, you gotta dig into it. Read the white paper, read the reference materials to the white paper. Try to get a full picture for what they were trying to achieve with this. And try to establish how you can best participate in it. See, I think that mining, as it's been described, was not meant to be as centralized as it is today this far along. And as I said, this last Bitcoin Cash thing, the forking, it should be obvious to people what that interest is, what's being expressed in mining. And when you think about how awesome that power is, and that it could just as easily be in your hands as opposed to the hands of, say, Roger Ver or Jihan Wu or Craig Wright or any of these other people out there, that it should be in your hands directly. You know, and it's one of those things where you have to think about it in terms of, you know, maybe it's just not me that is in opposition to how things are going on the Bitcoin network. That maybe some other people feel that a lot of the BIPs instituted since, I think it was like BIP 8 or something like that, that they don't seem to be serving the community as a whole and seem to be funneling the function of Bitcoin to fit into a mold that will make it operate in a way that is very much different from what was originally intended. And you know, maybe it's not just one of you that feels that way. Maybe there are, I don't know, maybe tens, maybe hundreds, possibly even thousands, maybe even 1 million. You don't know. But if you were to seek common interest among other low-scale miners, you know, while you individually might not have enough hash power to really make a dent in the BIPs that are being enforced, and you're not necessarily finding a whole lot of blocks, maybe the tens or hundreds, possibly even thousands out there that agree with you, and who would be willing to dedicate what little electricity, bandwidth, and hashing power they had to the effort, possibly then you could push consensus rules. Maybe then you would be finding some blocks. You're not obligated to stick with just the biggest pools. If you want to represent your interest, you got to do it with skin in the game. You got to have hardware. You have to have electricity. You have to have bandwidth, and you have to be dedicating it to the coin that you support. It doesn't even have to be Bitcoin. You know, there's only 2,100 other fucking options out there for you. I'm sure one of those coins operates within your your expectations of a cryptocurrency. Maybe it has the same features that you find would make Bitcoin work even better. And it's up to you how you want to dedicate your resources. Unlike a lot of people, I am not here to tell you how to mine. I'm just telling you to mine. Because that's the best way to participate. When all of this hash war was going on, if you were doing nothing, if you were just saying, you know what, I'm running Bitcoin Unlimited on my miner, and I can give a fuck what Roger Ver has to say or anybody else, this is the version of Bitcoin Cash that I like. You would easily be readable on all of the charts, along with everybody else that was supporting it. But you'd be expressing your interest, and that's an interest that a lot of people have been handing off to these mining pools and saying, oh, I just trust that they're going to dedicate the hashing power to the variant that I support, that I like. But they have interest too. It's just like the Federal Reserve. The Federal Reserve is a private entity. They have direct relationships with the federal government of the United States, but that's via the Treasury and Congress. But it is a private entity. It has its own interests. And that's why, regardless of what the United States wants, they're going to loan money and issue money and up the interest or cut the interest or accumulate or dump as they see fit, and according to their own interests. And this is the power that I'm talking about, operating according to their own interests. If you have skin in the game, you can operate according to your own interests. You could mine on the pool that is most likely to be getting blocks. You could mine the variant that is most likely to be giving you transaction fees. But it's up to you to be able to decide that, or up to you to decide that for yourself. It's not up to the pool operator. It's not up to anybody but you, especially if you do have the mining hardware yourself. But then you got to be doing your homework and making sure that you are actually representing your interests and not conducting a 51% attack on somebody else's behalf. As I often suspect is at the root of many of these movements that we do see within cryptocurrencies. But anyway, now that we've gone from where we are back to where we started, let's jump back into the present. And I got this article here on Reuters.com. Oil and Bitcoin highlight growing risk of market crash, BAML. This is authored November 16th, 9 a.m., updated 11 hours ago by Helen Reed. So no penis. The risk of a flash crash in markets is rising, strategists of Bank of America Merrill Lynch said on Friday, after a week in which previously booming cryptocurrency Bitcoin tumbled, oil sank, and investors piled into stocks perceived as safer. Rising volatility across a range of asset classes and rapid deleveraging like that seen in oil markets in recent weeks are signs that a bear market could have further to go, they said. Brent crude hit an 8-month low on Tuesday in its steepest one-day fall in more than 3 years, and Bitcoin hit a 13-month low on Thursday, the latest asset to fall sharply. Quote, sell rallies, strategists at the U.S. bank advised clients, saying that despite sharp falls in the stock market, positioning by institutional investors was not pessimistic enough to signal the market could be at rock bottom. Quote, ingredients of flash crash rising, bond, FX, equity volatility all trending up, vicious deleveraging events, dislocation risk via abnormal spreads, triggers could be violent U.S. dollar. Triggers could be violent U.S. dollar move and or stock shock, macro data forcing abrupt GDP and earnings downgrades, they wrote. The bear market has been such that cash has outperformed stocks and bonds this year for the first time since 1992, the strategist said, noting that despite this $122 billion has flowed into equities, $35 billion into money market funds, and $24 billion into bonds. This week saw modest inflows of $4.6 billion into equities, while bonds suffered outflows of $5.2 billion, EPFR data showed. Corporate bonds saw big outflows. Investment-grade corporate bond funds lost $2 billion, and high-yield bond funds lost $2.3 billion. Indeed, the next assets to drop could be high-yield credit and the U.S. dollar, BAML reckoned, which is up 5.1% year-to-date. Quote, "The last bulls standing are high-yield corporate bonds," the strategists wrote, and the U.S. dollar, which they see climbing further into the end of this year, the first quarter of 2019, before falling. In terms of regional flows, investors pulled $1.3 billion from European equity funds, which have seen outflows for 35 of the past 36 weeks, meaning they've been selling. U.S. equities, the world leaders in terms of performance and valuations, saw $2.6 billion of inflows. A nascent appetite for emerging market stocks was visible, with $1.2 billion going into the region, its fifth straight week of inflows. They're buying the dip. Apple sours as investors turn from growth to value. Apple, which BAML strategists labeled as, quote, king of buybacks, has cracked, they said, as the stock fell to below its 200-day moving average, a level seen as important for sentiment. Apple shares are on course for their worst month since April 2016 and have suffered 7 consecutive weeks of losses as the iPhone maker's weak results and stress in the semiconductor space dented the stock. Its recent decline signals share buybacks, which had been a key driver for the rapid rise of U.S. stocks, are no longer sufficient to fuel the market. This year has seen a record $800 billion of U.S. buybacks so far, yet the S&P 500 buyback index, which tracks the performance of the 100 stocks in the index with the highest buyback ratios, is just up 0.9% year to date and down 5.9% this quarter. The recent decline of U.S. tech stocks like Apple, which had led the market higher, is one symptom of a building rotation from, quote, growth stocks into value stocks, further evidence this week with $1 billion flowing into value-focused funds and $0.6 billion leaking out of growth-focused funds. Defensive. Steady revenue and high dividend yielding sectors like healthcare and utilities also led the way in terms of inflows, except for GE. Some $1.1 billion poured into healthcare funds and $700 million into utility funds. Yeah, unless you're GE. Financial funds, meanwhile, saw $1.2 billion worth of outflows. Yeah. So, it seems to me that there's a different trend going on. Instead of growth to value, I think it's seen more from investment and this monetization of risk or securities or whatever. I think it's all coming to an end, where people aren't looking for places to just park their money and maybe reap on some international interest or some shit like that. That they're looking around themselves and saying, what is best to invest in? Okay, so maybe bullets and oil and silver and gold. You know, gold's seen some interesting activity as of late. But with regard to Apple is a maker of very high-end hardware. And when I say high-end, I mean that just it's expensive. It's not necessarily the best performing. It's just expensive. You know, when you can get the same functionality out of a $35 Raspberry Pi as you can out of your Apple iPhone, why are you going to spend the additional $970 on an Apple iPhone? You're going to buy a fucking Raspberry Pi. I would. But it's this value decision that people are looking at, I think, where we are going to see a bit of a drop-off because companies like Apple and Facebook and Twitter and Google, those among the highfalutin stocks, that they've been selling their integrity and their underlying values out from under their customers. You know, that for Apple, I think it's transitioned to a lot of its production being overseas. That was like the first clarion call that, you know, they don't really care about your interests and they're trying to insure themselves against the negative impacts of your interest. You know, they don't want you to be profiting where they could be profiting, of course. You know, and so instead of employing people here in the United States to make their stuff, they ship it over to China. But I've said this a multiple number of times, and I'm going to continue to say it, and we are going to see some results of it coming up this next year, is that oil, the market for it, has been greatly manipulated via a wide number of avenues, and one of which has been illegitimate volumes of oil coming into the market. And when I say illegitimate, I mean that the volumes of oil were stolen as opposed to sold. You know, they weren't actually paid for, or at least they weren't paid to the nation which the oil was extracted from. And you see, as these nations get their legitimate governments back under control and are able to kick mercenaries and shit back out of their oil fields, and they get containment on the supply exiting their countries, we're not going to see this less than $100 oil anymore. $100 a barrel oil, just because it is way too expensive to frack. It's actually an energy negative to frack. You have to offset it with things like stolen oil coming into the market, because you cannot afford to sell the oil at $100 and not have something to cushion the loss. And so, yeah, I think that because those sources of oil are going to be drying up, that access to oil, or at least cheap enough oil to afford to ship products across the ocean for no greater purpose than for you to have a newer, shinier iPhone than your next door neighbor, that frivolousness is going to exit the market. And in realistic terms, you know, them talking about this being a quote unquote bubble, yeah, it is a bubble. You know, you can afford to be interested in $1,000 iPhones when you can afford to ship them across the ocean, and they don't actually cost the $4,000 that little piece of hardware actually would if it were produced here. Or if the company shipping it across the ocean actually had to pay for the fuel at the market rate that would be given if there were a national government in charge of selling it. You know, these deferrals of cost are ending. And so the market is starting to get a little more intelligent about how they spend their money. They have no choice. It's coming down to, do I feed myself? Do I keep the lights on at my business? Or do I keep doing things the same stupid way that I've been doing it and just pissing away money on bullshit? And some people aren't going to get this message. Bankers will not get this message. Financial operators will not get this message. And they won't get it until very, very late. And by the time it does hit them, it'll be due to lack of market participation, that people will simply be closing their accounts with them. And I see that as something that's going to be on the rise too, because, when you can afford the offset of operating through a broker dealer, because they have to charge you for their actions because it costs them money to register with the SEC and the CFTC and the FDIC and all the little organizations that are sticking a hand in their pocket saying, you got to register with us. That they're going to be looking at that, and then they're going to be looking at cryptocurrencies, and they're going to see that even transacting Bitcoin on chain, it will be ultimately cheaper for them to be shipping around their investment funds via Bitcoin and other cryptocurrencies than relying on their broker dealers. They will be saving hundreds, if not thousands, if not millions of dollars in fees and taxes and transfers and blah, 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 blah. They will be assuming control over their own funds as opposed to relying on third parties to transact it for them. They will be determining the vehicle by which it's transferred. They will be evaluating the fee structures of the different coins available and the different cruft and all the bullshit that's associated with setting up a wallet and scan, enter, send. I did myself a favor the other day. I've got this device that I'm not really using for anything else. And so I've decided to elect it as my experimental device. And one of the things that I wanted to do was check and verify how simple it was to set up a Verge wallet on this device. And it was incredibly simple. As a matter of fact, the experience for me was not at all dissimilar from the first Verge wallet that I downloaded. And where I see the utility of that is that as we go on, people are going to be looking to get around the cruft. And not by illegal means, just means that aren't easy to track and are out of the realm of any kind of regulatory action. And one of the big breakers, the maker breakers in setting up stuff is going to be how easy is it to set up the wallet and just do a regular on-chain transaction. No frills, no smart contracts, no multi-sig, no bullshit. A straight peer-to-peer transfer. How difficult is it? And I'll tell you what, it was very, very simple to set up a Verge wallet. See, this is another one of those indicators to me that they actually intend to be here for the long haul, that they intend to be used as money and on-chain money. Patent-free money. Global at that. And that's the thing that you have to be watching out for. I did use the Google Play Store to download it. But it does have Tor activated in it too. So get Orbot with another download, which it actually links you straight to, which I found very cool. But anyway, point being is, if you wanted to have a simple to use wallet that you can move money around to anybody on planet Earth, receive and send, the Verge wallet actually does it. And I think that that's something really important, because the push I see on Bitcoin and Bitcoin Cash is to get you transacting in things that are not Bitcoin or Bitcoin Cash, whether they be colored coins through Worm Butthole or Lightning Network and Liquid LBTC through Blockstream or Atom Back or Lightning or I don't know who. But that they have in mind for you to be transacting in abstractions of these currencies, not the currencies themselves. And I can tell you what the effect will be, pretty much like we've seen with quote-unquote stable coins. They've got you transacting for quote-unquote stable coins that supposedly are actually backed by a fiat currency, supposedly, instead of the fiat currency itself. And this allows them an avenue to distort the value of cryptocurrencies versus fiat currencies, because they can wave the magic wand and bring a fucking volume of additional USDTs or USDCs onto the exchange and sell you those instead of selling you US dollars in exchange for your Bitcoin or Bitcoin Cash or whatever the other currency may be. And in my mind, that distorts the US dollar value or the fucking euro value of a cryptocurrency, because it's being exchanged for something else. It's not being exchanged for something that we have an accounting for in volume of US dollars or euros or Chinese yen or whatever. But the point being is the exchange isn't being made between a cryptocurrency and a fiat currency, and because of that, the price of that cryptocurrency in fiat currency is also going to suffer that distortion. Because the Bitcoin that could have been sold for US dollars was sold for USDT instead. Again, an entirely unaccountable unit of exchange. If it were actually paired 1-to-1, I don't think that we'd be seeing the distortions in the offset of price. You know, when you actually put it against US dollars, you find out that it's only worth 95 cents on that market. Anyway, let's go ahead and throw back down into some music. And I'm feeling the need for some ministry here. So here it is, Rio Grande Blood, here on Coin Metal. And that was Helmet with Unsung. And it is with that I'd like to close out this episode. We will be back again on Monday at 8 p.m. Pacific Standard Time. And so until then, you can find me on Twitter, on Facebook, in the chat room for Verge Currency, also on either Telegram or Discord. And so yeah, watch out, man. You got to be determining what your role is in all of this. If you want to participate as solely an end user, you will be treated as an end user by everybody. But you're not actually relegated to participating exclusively as that, and so I strongly suggest that you don't. That you get into the game, that you get into deving, that you get into mining, that you get into participating as everyone was supposed to be here in the cryptosphere. And so it is with that. Like I said, I'd like to close this episode out. We will be back again on Monday. And so until then, I'd like y'all to trade safe. Do your homework. And watch out for your own bunghole, because nobody will do it for you. Not even the SEC. As far as our last dance is concerned, I'd just like to convey my thoughts during the whole quote-unquote hash war. It's by Death Angel, Bored. Last Dance here on Coin Metal. Thanks again for listening, and you all have an excellent evening.